It is Tuesday, January 21st. We have a rock star group this morning. We have Charlie Peabody, who's going to kick us off with financials, then Berna Barshay, who's going to be talking retail and the consumer, Jeff Macke, also hot in the trail of all trends retail, and your host, your moderator today, Nadine Terman. That's me, with a smile and some Euro trash music that I sent out, according to Charlie Peabody. On that fun note, Charlie, lots going on last week. I just wanted to wake you up. You're still dancing. You're still dancing. Any John Summit fans out there? Come on, support me here. It's a good one for Focus. It said the title was Focus, so let's focus here, Charlie. What do you got for us?
No, I can't after that music. But anyway, you sent some good music. That wasn't it. All right. Anyway, so last week, all the major banks reported earnings Wednesday through Friday. It was just a big mosh pit of numbers. But so I wanted to start off talking a little bit about the price action related to those earnings numbers that were released and the implications that the market is reading into the fourth quarter earnings. So if you put up the first chart, Jen, you can see on the very left-hand column where prices closed last week, and then the weekly change in prices. And bank stocks rose on average, these are the large cap banks, 8% versus only a 2.9% increase in the S&P and a 6.1% in the XLF. So bank stocks outperformed the broader market and broader financials. And it really was a function of the fact that earnings were a raise and beat in the fourth quarter. And that's something that we highlighted here on Wall Street Beats back in mid-December. You can check the posts that I put on there in terms of my earnings expectations. And I was way above the street. If you look at January as a whole, which is the far right column, you can see bank stocks throughout the month, not just last week, have outperformed the market as well and the broader financial indices. But there's a bifurcation starting to take place within financials or bank stocks. And what you're going to see if you look at the far left-hand column or the far right-hand column for January, last week's performance or January's performance, you're going to see that the stocks that are related to capital markets are really the ones that are outperforming. Whereas the regional banks that are driven more by interest rates and loan growth, or what we call net interest income, are lagging. And there's been a significant underperformance. And within that, what you also see is stocks like Goldman Sachs or JPMorgan or Citigroup or Morgan Stanley are making new highs. Whereas stocks like US Bancorp or Truist or PNC aren't even getting close to their November 25 highs, the post-Trump rally highs. And they're actually starting to fail at their 50-day moving averages. So
why is that? So can you put in perspective, right? Sorry to interrupt here, but put in perspective for people. Why is that happening?
So the way I read it is that people have a lot of confidence that capital markets activities are going to remain robust, at least through the first quarter. There's visibility to that. First quarters are typically seasonally strong. But in addition to that, if you looked at the investment banking revenues that were reported in the fourth quarter, they were way above even the robust guidance we were given in mid-December. So it tells you that December month itself was very robust. So there's a lot of momentum in the capital markets, and that activity is really not heavily dependent upon Trump policies. On the other hand, the rate structure and how it plays out here is very much dependent upon the Trump policies, and more importantly, the sequencing of those policies. In bank land, you can get things done either through executive order, through regulatory fiat. There's a lot of things that are going to be done through the reconciliation system process. And then finally, congressional approval. Those are the four ways you think about things getting passed. And quite honestly, a lot of the bank stuff is going to be back-end loaded. The policies that would spur or have an impact, I should say, on which way rates trade or which way growth develops. And so there's some uncertainty to those rate outlooks and those loan growth outlooks because we're not sure how the sequencing of the Trump policies are going to play out. And I think that's one of the reasons.
What do you do, though? So what do you do here, though, then? So you've had this rally in some names, not other names. And so is this like a stock picking exercise currently? Is it a wait and see? But then once you see, it's too late. So how does someone deal with this uncertainty?
So now we've reached a point where the banks have partially re-rated to expect positive outcomes from the Trump policies, particularly around a lighter regulatory touch. And so banks are trading around 60% of the market multiple. They used to top out at 55%, but once we heard what Trump was up to and expected deregulation to be a major force, we thought we could get a re-rating to 60, maybe 65% of the market multiple. We're there now. So my attitude is you do not chase the stocks here. And this is where you have to decide whether you're a relative player or an absolute player. I think we're going to get a decent correction in the first half of this year in financials. And so I am not chasing them. But if I'm a relative player, I think banks do continue to outperform the broader market. And then
so you're not shorting just yet. So you're pausing on a short, but at some point you think this is a short?
I would say I actually did put on some regional bank shorts on Friday afternoon, late afternoon. So I may be jumping the gun a little bit here. It's against a lot of longs in other areas. But I do think banks will outperform relatively. And then the question is, which section within banks? And I want to own the money centers and the capital markets names and be short the regional names and maybe even some of the consumer finance names. So, Jen, just very quickly, and I'll go through these very quickly, Nadine, and then we'll turn it over. This shows the earnings for the fourth quarter. My estimates, the street estimates, and the actual are the first three columns there. And the one thing I want to point out is that the biggest beat relative to street expectations was at Citigroup, which has been my number one pick and the one I highlighted coming into the earnings season. And if you look at Citigroup's reaction to that, it was a skyrocket type of reaction. The stock moved to a new 52-week high. And it was largely because they beat both on revenues and expenses, and then they announced a share buyback program that surprised people in terms of how robust it was. And then the last slide, and I'll just do this very quickly, Jen, is just showing the revenue in this industry. I don't know if you can bring that up, Jen, but there we go. Revenues actually were very strong for our industry. They were up 6.7% for the big banks on average. And that was largely driven by a positive inflection point on net interest income, which is something people pay a premium for, and very robust investment banking and trading revenues and wealth management. And there's no reason to believe that capital markets momentum is going to slow anytime soon. So those are the things that are driving the optimism around this group.
And so let's go back to Citizens, right? Or is it, so CFG, I remember you talked about before, you've got Citi. So a few names, what do we do with these? Because I'm looking at CFG and that popped high. Should people be taking money off the table here on some of these names? Or is this the room to run?
I would sell upside calls. I would sell upside calls. Yeah. CFG, I will mention that for a little bit because it is a unique situation. This is a bank that's in transition. If they execute right, you're going to see double-digit earnings growth over the next 2 years. The question is, what's the macro environment going to be? If we have higher rates, I think they're going to fail to achieve their goals.
Okay.
Now, I want to stress rumor. This is rumor. There is belief that PNC is talking to CFG and that Bruce Van Saun, who is the chairman of CFG, is tired. If he hits his goals, I think he'll stay independent. But if he falters, then what is a turnaround story becomes an acquisition story. And that's the reason I like this one. And I think it could go for $60 a share if they're bought out.
Okay. And I'm looking at here, it's at 48 and change. So a lot of room to run still. That's a nice buyout offer if that would happen.
Yeah. But by and large, if you look at US Bancorp, that's lagged. It's failing here at the 50-day. If you look at Truist, which is to me a good total return stock because you start off with a 4.5% yield, and they're starting to execute on their promises after faltering for a couple of years. That's an interesting one that if things sold off 15%, I would like to put that one up.
Okay. Thank you, Charlie. We're going to head over to consumer land. Berna, what is on your radar today and for this week?
I was planning to recap the ICR conference that I was at last week and give some updates.
For those who know, what is ICR? Let people know.
ICR is it's a outsourced investor relations firm that puts on this big conference. There were about 3,000 people at it between company managements, public markets investors, and private market investors. So a lot of PE and VC types running around, about 1,200
A lot of
public.
polices, a lot of police vests going on. Okay.
So yeah, there were definitely some police, and it was chilly in Orlando in the 50s and 60s. So definitely police vest weather, quite a disappointment, but definitely warmer than the 7 degrees that it was in New York this morning when I went outside. I'm going to get to some specific names in a bit that just review names that have been well trafficked here on our show, but just a couple of things in context. A lot of retail companies, a lot of restaurant companies. Probably the biggest surprise, the retailers, was the lack of fireworks. Usually you have a lot of stocks moving up and down 20%, and we did not get any big up movers except for Aritzia, which instead of releasing Monday morning, released the Friday before. So there really was no big upside. The basic messaging, there were a couple of companies that were down quite a bit, which I will get to. But the basic messaging was the consumer's doing okay. As we've talked about, despite the doom and gloom headlines, despite the building credit card balances that Charlie can, I'm sure, expound on, the consumer spent over Christmas, but investors were like, okay, thank you, next. What are we going to do now? The biggest surprise that I had in sort of the meetings was that nobody was asking about tariffs. If this conference had been this week instead of last week, I think the questioning would have been very different. Restaurants, definitely a little bit more positive on the consumer on the margin. A lot of emphasis still on value menu items, but they definitely sounded better than they did 6 months ago. They see mid-single digit inflation in their costs, combination of beef prices going up, some other commodities, as well as some minimum wage increases cycling in different states. But they think they can take the pricing to cover that.
Really? More from here?
Yeah, I know.
Wow.
When they take 5% pricing, they don't take it 5% across the whole menu. They take it selectively in items that are hot. They hold the line and don't raise prices on some things that consumers are really focused on. They're smart on how to do it. In terms of the standouts, again, as I said, the sort of big mover to the upside was Aritzia. The other standout in terms of buzz, and unfortunately I did not see this company, was Amer Sports. A lot of people talking about that one, which is the parent of Architects and a bunch of other things. But people seem to be excited about that story, and that's something I have to dig in. On the negative side, Signet, the jewelry company, I think we've talked about it here in the past, just an absolute disaster, was down 20%. They had guided to comps up 3. They came in down 2. Engagement was fine. It was a fashion jewelry problem. They were all bulled up on the lab grown stuff, but this is pricing pressure in a business that has fixed rents and labor inflation and
no competitive advantage, right? It's kind of
like a secular disaster to me. Would not touch that one with a 10-foot pole. In terms of, I want to go through some of the names that we've talked about in the past on this show. 2 that I've talked about a lot, Five Below. They introduced their new CEO. I think this continues to be a story about merchandising, and now we have a new CEO who's a merchant, which we've seen work at companies like Abercrombie. There's some reason to be hopeful there. This was not a positive catalyst for the stock, because anyone listening is going to know that they have problems that are going to take multiple quarters to fix. That's not a surprise to me. And I think the patients will be rewarded here, but really nothing new. I met with Alico, which I talked about the last time I was on the show, which has transitioned from being an ad company to being a real estate company and selling off their land in Florida. One thing I did get confirmation on is that the 75% of their land that will be agricultural going forward, they have no intention of operating themselves, so it will be leased or sold. So that was good to know. It sounds like they are very busy. No real details there. The stock moved up 8 to 10% off of their meetings. This is a tiny little microcap company, and getting their story out is part of getting the value realized there. So I'm constructive there. Another stock I've talked about in the past where I remain constructive, and I think we heard good things out of at ICR, was Planet Fitness. That $15 price increase, the first price increase in the company's history, is having no effect on churn, no effect on new joins. it probably is having an effect, though, on franchisors getting more interested in building stores for them because the economics are easier to make work at $15 a month versus $10 a month. So all positive there. You've seen the stock move up. I think that's just like a steady grinder up, and all's going well there.
What's the thesis on that other than the price increase? What's the thesis for people who might not have heard you talk about the name?
And the thesis is just a lot of it is the price increase. You have a franchise model. They hadn't taken pricing in ever, and they took a 50% price increase. So obviously there's a lot of leverage on that in the company-owned stores and a lot of incentives to get franchisees to come on board now that the economics are better. It's still the cheapest game in town for a functional gym that gets the job done. And if the economy is bad, people might trade down to it. People are unlikely to quit something that is $10, $15 a month that they actually use as long as they're employed.
I wanted to know, so for if people didn't hear you before, that they
and there's a research piece up on the site on it.
Great.
It's a great cash flow generator, and there's benefits in scale doing this low cost gym model on a national scale. They can benefit from national advertising, and there was a lot of concern around whether or not the price increases would lead to churn, but they're not. Yeah, good model. The other one that we've talked about a lot here that was frankly a shock to me, and I think a lot of people, was the big move down in Abercrombie, down about 20% on Monday. They pre-released the Q4 results. They beat their own guidance. They beat the sell side. It was a bit of a head scratcher for me on why the stock was reacting so badly until I was in a breakout meeting with the company and other investors. And about halfway through, somebody raises their hand and says, the credit card data that I buy says that your sales were going to be up, whatever it was, 11 instead of 8. And basically the stock sold off because so many fast money hedge funds were positioned around the credit card data. You have the sort of bogey of their own guidance of a whisper number, but then you have this other number that is the credit card data, which for people who don't know how this alternative data works, there are data sets that aggregate tons of people's credit card. They make deals with banks that are issuing credit cards, and they get tons of anonymized data of transactions. So in any given credit card data set is only going to represent a few percent of what's out there in terms of credit cards, but usually it's directionally right. And it created a hurdle that the company couldn't cross. Maybe there was some kind of tracking error in this particular data set, some bias that made it not look like the overall data of who goes to Abercrombie. But it just goes to show, I think there's a bigger takeaway here that with the proliferation of third-party data and people trading on it and not everybody having access to it, I think it's going to add more volatility around earnings events and actual results. Because it's one of those things where if I had the press release the day before, I'm not sure I would have sold my stock because the numbers on an absolute level look pretty good to me. On a relative level, relative to some number that the company never endorsed, they didn't make a mark. I think that what this means is buckle up for more volatility around data points, but more opportunity for those who have longevity and either investing their own money or with investors who have a longer time horizon can suffer that. And then the final thing I'll mention, this is a name I've talked about a lot, is Crocs was not at the conference for the first time in about 10 years. And the reason that I heard for that is they recently promoted their CFO to be their COO. And so there was a new CFO quite recently. And I think the official party line was they didn't want to send the CFO into that environment quite so soon. I'm a little skeptical of that. I've not sold my stock. I would because I'm, again, long-term on this, and I'm playing for a turnaround in the Hey Do brand. And I think the the stock at around 100, where it is right now, basically prices in zero for this business that has, I forgot the exact number, about $700 million of sales annually and is profitable. I think $100 is what just
Oh,
the
watch this.
brand is worth. But I would not be surprised, just being a conspiracy theorist, financial conspiracy theorist, that the reason that the company didn't come is they literally have, for at least 3, 4, 5 years, every ICR, they have positively pre-announced and raised guidance above what people were expecting. And maybe they couldn't do it this year. And maybe that's why they're not there. Usually I would be out there buying stock with the under 100, but I think I'm just going to wait and leave ammunition because I think this stock could go down before it goes up. Long term, I remain bullish.
Thanks. Let's push it over to Macke. Macke, what was your take on whether these names or other names in the space?
Yeah, Abercrombie continues to just trade like smoking death. And I took a look at the entire mall complex, basically, which is Abercrombie, American Eagle, and American Eagle, Abercrombie, and Gap, which together are $20-odd billion, and pretty much your entire specialty. American Eagle's sort of the patchouli smelling burnout of the group who has been near to well. These are the returns over the last 8 years. Abercrombie up 1,000%. AEO and Gap have been more or less dead money. These are really cheap stocks. And I think the big bet on Abercrombie is, holy crap, you have to regress to the mean. It's still only trading times 15 times earnings. But the idea there is that things can't get any better. And so they almost have to get worse. But when you get right down to it, I'm looking for kind of the best mix that I can find there anyway, of value to any kind of compelling growth story is Gap. I think they have something going. Richard Dixon, I think they've got $2.5 billion, $2.3 billion sitting in cash. It's a $9 billion market cap. The stock has been dead money for decades. You don't need to be that good. I think that they can positive comp in this environment. And you're just seeing the return to office works for them in a lot of ways. The leisure market exploding should work to them better than it has. And they finally have a CEO in there who isn't from within the company, he's from the outside. And so nothing's sacred to him. That's the play on nickel at Starbucks. It's the same type of thing where we got really far on our culture and we can all just celebrate ourselves over the glorious story that is the cultural penetration of Gap and Starbucks. But after all, you really need a new CEO to take it to the next level.
Sure.
I think both those stories that's your catalyst, and that's good enough for me. And I think that's how we are in the mall. It's not that great a consumer. You can't be long all these stocks. So almost no matter what Abercrombie says, it's like, screw it. You're not growing as fast as you were. Get the hell out. And what's next? Maybe it's yet another possibly failed turnaround to Gap. These stocks at these prices with a consumer that's even meh, you can make a lot of money. It's, again, Gap's at 9 or like 12 times earnings, give or take. And they actually have a direction that they're going in. That's pretty cheap. And I'm a buyer here, continue to be. We're already long Aritzia, so yeah, they're my new Canadian favorite retailer. I always like to be long one merchant from Canada. Since we sold our Lulu, now we're long Aritzia.
You're still long? It still has room to run, you think? Okay.
I think so. It's getting pricey. Would I buy it absolutely today? Maybe, but it's been a nice ride, and I really like the CEO, and it trades with 3-minute a goat, so you got to pretty much make an appointment and trade low volume foreign securities, and I'd rather just hold it.
Okay.
Like him here, love the Gap for longer term.
Okay. I think that's it for today, Charlie. I don't know if you're talking. Yeah, he's talking, but I can't hear him.
I sorry, I have a question for either Jeff or Berna. And I'm really looking for perspective here because I know that the major credit card banks have granted forbearance to a lot of consumers in the South that were hurt by the hurricanes. And now they're doing it to the consumer in California that were hurt by the wildfires. I don't know if that's a big enough swath of consumers to affect retail sales or any specific companies that may have geographical concentration in those areas. So I was just looking because that forbearance is going to end in about 6 months. So around mid-year, those consumers that are not having to pay their interest right now are going to be forced to start paying interest again. And I was just curious if that would have any impact on retail sales or any specific companies that have geographic concentration in those areas. Or is it just too small?
I think it's too small and too early. I think you got to get really specific and really, it's to the extent there is that kind of industry going on down there, there's certainly going to be displacements. It's a super concentrated little enclave of hyper consumers. Business isn't going to be great at some malls in LA, but for the most part, we're still sorting it out. It's way too early.
I think
and
the bigger question to me, the disconnect, I agree, it's too small. The disconnect to me is I don't think and this is more your area than mine, I don't think we've seen the complete fallout in terms of insurers and reinsurers. I briefly worked at a reinsurer in my career as an investor, not on the insurance side, but I know that people get excited sometimes after big events. You can take a lot of pricing afterwards. And so strangely enough, these terrible loss events become positive catalyst instead of negative catalyst. Sure. It's good. But one of the most interesting things that I saw and last week, like as all this was going on, was on Tuesday night, I saw a piece of research from JPMorgan say that the losses were going to be $10 billion. Okay. Yeah. And I got the same day, I got a piece of research from BCA, which is located in Southern California, boutique economics research company. They said, they were like, we're writing from Pacific Palisades and it's going to be $100 billion. Okay. So that's a big bid ask. The next day, JP Morgan raised it to 50. And so clearly the people on the ground had a better sense of exactly how bad this was. And I heard an estimate out of all places, the Hollywood Reporter, when I was doing my media work over the weekend, was at $250 billion.
Yeah,
so we're approaching Katrina level damage. And I haven't looked at, I was busy at the conference when I first looked at Allstate and Travelers, they were not moving very much considering, and there's a lot of issues around people being underinsured, but I don't think that this has totally worked its way into the insurance stocks and the reinsurers is my feeling.
Yeah, I was shocked on the JP Morgan conference call. They said that they didn't think that the impact of the wildfires in LA would have a material impact on their loss content going forward. Very skeptical of that comment, but they are the lead in influencing opinions on Wall Street. That was a surprise.
Yeah,
it will impact reconstruction. It's going to impact architecture. It's going to impact. It's in terms of where you get in your labor, where you're going to be able to build, the pace at which you're going to be able to deploy that capital. It would be a great thing to be designed sort of high-end homes for famous people. Right now, this business is about to get really plucky, but it's going to take a while to sort out who gets the money and when they can start building again. The building codes are going to be a real headache in a lot of those neighborhoods, just having lived out here for about 10 years. It's the legal morass they would have to go through unless laws start changing really fast. And how they change is you have to redesign the entire area and you have to re-landscape, you have to reroute everything. So
maybe go long Winnebago and temporary structure. So on that note, listen, it is January 21st, a Tuesday after a long weekend. We had our star-studded Charlie, Berna, Jeff, and me in support role here to support the stars. So thank you for joining us, and we'll be back tomorrow with good smiles. All right, have a great day, everybody.
You're a star in our eyes.
Oh, Charlie.